Okay, let's continue on with chapter 2 and let's talk about equity, the next asset class in our list. Of course, if we think about equity in general, there's three forms we can talk about. Common stock, which everybody is familiar with. Preferred stock, sounds very similar. We'll talk a little bit about preferred stock. And then something called ADRs. ADRs are investment in foreign stocks or companies from foreign stocks that do not trade, or at least these shares do not trade on an American exchange. So, what do you get with common stock? I'm sure you know you get ownership. When you own things, you get voting rights. You have the right to assets and profits. However, you only get those things if there's something left over. This is what's referred to as a residual claim. Corporations also have what's referred to as limited liability. You can only lose the value of the investment or the price of the stock that you purchased. So what can we talk about? Prices, right? Corporations be public or private. If they're private, then there are no prices for the securities. They're typically sold on exchanges. Individuals will have differences in taxes dependent on their particular income level, but also corporations have a different kind of a tax schedule from individuals. It's very similar in structure, but it's a little bit different. So let's think a little bit about these stocks. Let's think about this stock in particular that we're looking at. If you look across what information we know, we have a ticker symbol. Here's GAAP. The ticker symbol is GPS. Yesterday, or today, on this date, it closed at $21.81, and that's 14 cents higher than it was yesterday. So yesterday's close was $21.81 minus the 14 cents. 4.9 million shares traded hands. This stock, the highest it's been in the last 52 weeks is $40. The lowest it's been is $21. It's obviously a little bit closer to the low end than the high end. Dividends was 0.92. The yield itself was, if you purchase this, it's 4.22%. The PE ratio, 9.82. We're going to talk about all of these things later on. And of course, the yield to date percent change. This stock is down 11% over the past year. So how do you make money with stocks? Well, when you buy stocks, you could possibly get dividends. Dividend yield return is fairly stable for most companies. It's a rate of return based on the current value of the stock. And of course, capital gains is just the change in wealth as produced by the managers of the companies. Now, this really sort of represents future potential. So there is a variable and a ratio, a number in this last schedule referred to as the PE ratio. So what is the PE ratio? It's the market price divided by earnings per share. So this represents or demonstrates shareholder optimism. The higher the number, the greater the optimism of the shareholders. They're willing to pay higher prices. But if this number gets too big, it could mean that the stock is ultimately overpriced. One of the ways that I like to kind of think of this is think of it like being a payback number. Let's say that the stock price is 100 and earnings per share is $2. So that means the PE ratio is 50. Earnings per share, you're entitled to the earnings per share. So what this says is you'll need 50 years of earnings to pay you back for the price of the stock today. So if the PE ratio was 10, that represents 10 years to get your money back. Whatever that money is, it's 10 years to get it back. If the PE ratio was 100, it would take you 100 years to get your money back. And I think you can see if the number is too high, we really could start thinking about maybe the stock is overpriced. At the same time, if it's very, very low, we might be thinking that this stock might be underpriced. So it's a measure that we might use in some of our decisions on what stocks to buy. Equity securities in the form of preferred stock. These are a hybrid security. They look like a stock, but they pay interest or they pay dividends like a bond pays interest. So there's fixed dividends. It's a stock without voting rights. It has priority over common. Again, we had talked about this earlier, that common stock has residual ownership. And as far as taxes are concerned, dividends are taxed like stocks. Currently, that's at a lower tax bracket, but bond income is taxed at higher rates, whatever your marginal rate is. So if you're in a 30% tax bracket and you were going to receive $100, you would rather pay taxes on $100 of dividends than to pay taxes on $100 worth of interest. You would get to keep more money, if you will. ADRs are certificates of foreign stocks. Typically what happens is banks purchase these and they hold them in inventory. So investors buy a piece of paper that represents the stock that's in the vault of the bank. Essentially why we might want to do this is to avoid the issues of having to deal with foreign securities, foreign currency. So the last couple of things here, we want to talk a little bit about some indexes, how we look at things. So one of the primary indexes that I'm sure you're familiar with and have heard of is what's referred to as the Dow Jones Industrial Average. There are 30 large blue chip corporations. It's been around for well over 100 years. Every once in a while they'll adjust it. It changes when one of the companies becomes not one of the top 30 anymore. So a company can leave if it loses market value, and another company will take its place. It is also adjusted for things like stock dividends and stock splits. The idea of an index, if you think about what an index tells us, it represents the average price change of a stock in the stock market. So when this thing changes, your assumption is, well, if my stock is like all other stocks, my stock may have changed at this percentage rate. It's what's referred to as a price-weighted index, right? So it represents the average rate of returns for those stocks that are in the stock market index. The S&P 500, again, represents the average change of stocks in the market, but it's based on the 500 largest companies. It's what's referred to as a market value index. It represents the average change of the market value of the portfolio of stocks. So again, whether it's market value weighted or price indexed, the idea is this represents what we think happens to average stocks. So investors can base their portfolios on an index. So maybe we buy an index mutual fund, or we buy an index fund through exchange traded funds, and these are portfolios that are created to represent and match what the indexes themselves earn. So you could buy, if we think about indexes, you could buy an S&P 500 index. It's called a SPDR, and that SPDRS, right? Spiders, right? That mutual fund, that index is there to represent what happens to the S&P 500 itself. And of course, we have U.S. indexes, we have foreign indexes. There are lots of different measurements of markets out there. The last thing to kind of talk a little bit about are what are referred to as derivative markets. Derivatives have two basic types of securities, options and futures. A derivative gets its value from another asset. So if we're talking about options, right? When you purchase an option, you are essentially predicting the price change of that asset. So a call option is the right to buy an underlying asset at its strike price. A call option represents a strategy to buy the underlying asset. So you buy a call when you think the stock price is going to go up. A put option is the right to sell an asset when the value of sell it at the strike price. You purchase a put option if you think the stock price is going to go down. And of course, the values of these options change as the variables of the underlying asset change. So as time changes, premiums are, as time commences, that means it gets closer and closer to maturity, premiums are going to decrease. A stock price increases, then puts go up, puts go down, calls go up. If the volatility increases, the value of options increase. Again, I don't want to get into too much detail here because we have several chapters at the end of the course to talk about these derivative securities. A futures contract is an agreement regarding the delivery of an asset, again, at a specified date at a specified price. You can take a long position, which means at maturity you would be buying the asset, or you could take a short position, which means at maturity you would be selling this asset. So these two things, options and futures, sound very similar. An option is the right but not obligation to buy or sell something. But a futures contract is an obligation to either make or take delivery. Options are exercised only when it's profitable, and a long or a short position, you either have to buy or sell at the futures price. So futures contracts are entered into with it says without cost, but very low costs are involved with actually buying a futures contract. So the premium, though, of an option is the price of the option itself, right? So you have to buy the option, and there is a set price that obviously is published. So for the next several slides, let's talk about some problems that we might want to solve. We have an investor that can earn 3.25% on 6-month T-note for every 6 months on a treasury note with 6 months remaining till maturity. The face value is $10,000. The question is, what price would you expect this treasury bond to sell for? So the value of a discounted security is the maturity value divided by 1 plus the return. In this case, it's at the semi-annual return. So in this case, it's 1 plus 1.0325, right? That's the yield that you can buy it at. So this particular treasury note you could purchase for $9,685.23. When it would mature in 6 months, you would receive the total of $10,000. So let's look at some treasury issues, right? So how much would you have to pay to purchase the November 15th, 2041 bond? Well, here's the bond. It's right here, right? What we want to know the asked price. That's what you have to pay to buy. In this case, it's 111.8293. For a bond, all you do is move the decimal place 1 to the right, and you get the price. $1,118.203. What's the coupon rate? 3.125. That's $31.25 a year. If you divide that in two, you'd receive $15.625 semi-annually. And of course, the yield to maturity on this is 2.496. So if you bought this bond today for 11.8203 and you held it till November 15th, 2041, you would earn on average every year 2.496%. A corporation buys a share of stock at $105. It sells at the end at $105. It receives a $15 year-end dividend. The firm's in the 21% tax bracket. So what is the after-tax return of this investment? The important part of this question is, what rate of return do corporations pay on the dividends from other corporations? Corporations get a 70% exclusion. So if they received a $15 dividend, they're going to pay taxes on only 30% of that. So 30% of the $15, they're going to pay taxes on $4.50. The tax to the corporation is the 21% tax bracket, so their after-tax income is $3.55. So what is the after-tax rate of return? $3.55 divided by the $105 price tells us that they earned after tax on their dividends 3.385%. So we see a general idea about what? How do you calculate the taxes to a corporation when they receive dividends? Next, let's look at stocks or a stock listing here. We're going to look at general dynamics. How many shares, full shares, could you buy for $50,000? The closing price was $142.97. If you divide that into 50,000, you could buy 349 shares. What would your annual dividend income would be? $3.49. Up here is the dividend of 3.04. So you would earn roughly $1,060.96. What is the company's earnings per share? Well, it's not really listed here, but what we have is their PE ratio and the market ratio. If you solve for earnings per share, 142.97 divided by the PE ratio of 15.39 tells you that this stock is the earnings per share was roughly 9.289 cents per share. What was the closing price the day before the listing? Well, on this day, it closed at 142.97, and that tells you that that is lower by 47 cents from yesterday. So in this case, you will add the 47 cents to get $143.44. Again, one more example. Actually, two more, sorry. An investor's in a 20% tax bracket. Corporate bonds offer 5.75%. What must municipals offer for them to prefer them to corporate bonds? So again, if we just solve for our formula for tax-exempt yield, in this case, we want to solve for the muni rate. You take the tax, or the yield, 5.75%, times 1 minus the tax bracket, we get an answer of 4.6%. So what does that mean? If you're interested in buying the municipal bond, if you would only buy the municipal bond if it earned a return higher than 4.6%, right? So unless it beats that, you wouldn't be interested in the municipal bond. And the last one is to just try to create a table that represents these equivalent taxable yields. So in this case, we say what? We have a term municipal bond offering yields of 6.25%. Depending on your tax bracket, what would the equivalent taxable yield need to be for you to be indifferent between the municipal and the taxable bond? So in this case, if you look at a 30% tax bracket, 8.93% is the yield. So if the corporate bond earned more than 8.93%, you would rather have the corporate bond than to have the municipal bond. So that's the end of chapter 2.